Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Charlie Ripley, senior investment strategist at Allianz Investment Management, to discuss how economic data surprises and competing results from backward-looking data and forward-looking data are impacting the investment environment. Charlie, it's great to have you with us. Welcome to Trade Talks.
Hi, Jill. Thanks for having me on this afternoon.
You got it. How have economic data surprises and the competing results for backward-looking and forward-looking data, how's it making it a more difficult investing environment?
Yeah, I mean, just take a look at this week, for example. We've had, an interesting 48 hours of labor market data where, we saw a huge surprise to the upside on the ADP data. And then you look at today's employment report data, a little bit weaker, on the margin in terms of the headline number, although we did see, a little bit of an uptick in wages and a decline in the unemployment rate. But I think, what it's trying to tell us is the data is a little bit mixed, and it depends on how you look into it. And some of that backward-looking data has been, somewhat strong. But, if we take, the labor market, for example, and look at things like temporary employment, maybe jobless claims, maybe average hourly or average hours worked per the week, a lot of that stuff is showing that, the labor market is starting to loosen up. And I think it's just taking a little bit more time for that to flow through the rest of the economy.
Why is the Fed so divided at this juncture in the hiking cycle? And how much higher do you think the Fed needs to go with respect to policy rates, particularly as the jobs data was hot for June, of course, June being the best month for jobs typically. So what do you think they are in the hiking cycle?
Yeah, really great question. And, I think we saw from the minutes that there is some division amongst the Fed members in terms of where we need to go. I think part of this is really predicated on, the fact that they've raised rates so quickly in a very short amount of time. If you look at, what we did from March of last year to where we're at today, it's 500 basis points of tightening in a very short period of time, and something that we've never seen in any previous hiking cycles. And so I think there is, some views that are out there that believe that there is some variable lag to some of this policy tightening that needs to flow through the rest of the economy. And I think when you look at a very data-dependent Fed and looking at where they need to go from here, our view is that they've done majority of the tightening, and I think we're going to get close to the peak of the tightening cycle here. It's just going to depend on where the data goes from here. And some of the stuff that we have seen is showing signs of a slowing economy, particularly the labor market data that we saw today. And there's other signs and some of the survey-based measure data that's showing, a weaker economy forecasted, ahead.
Why do you think this puts investors in a vulnerable position?
Well, I think it kind of depends on how you're looking at things going forward from here. I believe that the Fed is going to, orchestrate a soft landing in terms of the economy and not put us into recession? Or do you believe some of the other Fed members who think that we need to get more aggressive on rates and bring the policy rate closer to 5.5% or maybe 6%. I think that depends on, which direction they want to take. And, at this point, they've taken a pause in June. Seems like July is going to be, pretty certain for a rate hike after the data set that we've had. But where we go from there, I think is still going to be dependent on the data. And, what the data comes out and tells us is there is a lot of uncertainty ahead.
So finally, Charlie, what's the view of Allianz if the economy continues to slow and we do see some lagging data points? I mean, to your point earlier, this happened in 9 months. It's the rate of the interest rates, the 500 basis points. It hasn't filtered through yet. It doesn't, the economy doesn't respond to it in just 9 months. So what's your view if we continue slowing and this lagging data starts to catch up with policy?
Yeah, I think we're taking a more cautious approach in terms of where policy rates need to go from here. Like I said, there is, that possibility that there is some lag in terms of how the monetary policy effects are flowing through the real economy. And so, you look back and you say, 500 basis points of tightening has already been done. What is another 1 or 2 rate hikes really going to do to the trajectory of the economy from here? Probably not that much. And so when we look at, the things that matter the most to the Fed, which is, wages or, other inflation data points, we are seeing them, in a declining fashion, but maybe not as quickly as people, would like them to be. And I think that's part of the lagging effect that we're seeing play out here. So, our view is that, we think the economy just needs some more time to fully, fully feel the bite of, the monetary policy that's been put in place. And, maybe we get another one or two more rate hikes. But at the end of the day, I think, the economy is and we're going to see.
All right, Charlie, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Pleasure. Thanks.